So Sony just set roughly 88 billion yen completely on fire, killed their highly anticipated electric car project, and then somehow walked away with the single most profitable year in their entire corporate history. Today, we're going to try to figure out how.
Yeah, it's honestly a remarkable divergence between, public perception and financial reality. I mean, when a global conglomerate takes these massive, highly publicized write-downs and physically abandons a major hardware launch, your instinct is to price in failure.
Right, you think the ship is sinking.
Exactly. But looking at the actual data, those publicized losses were, well, they were just a smokescreen, hiding a really aggressive underlying fortress of profitability.
Welcome to the deep dive, everyone. For you listening right now, today we are tearing down the Sony Group. Specifically, we're looking at their Q4 2026 earnings conference call, the consolidated financial results for fiscal year 2025, and their mid-range forecast leading into FY 2026.
And we're going past the standard headline summaries here. We want to look at the actual structural mechanics of their business.
Right, like how they're wringing out more profit per yen of revenue, why they are spinning off major divisions, and how this new semiconductor partnership might actually make them the undisputed gatekeeper of, well, what they're calling physical AI.
We are also looking closely at independent analyst reports from Belfa Global Research and CFRA, just to verify management's narrative against what Wall Street is actually expecting.
Because Sony's evolution is, it's complex. They are actively shedding their legacy as a traditional consumer electronics manufacturer.
Yeah, to become this omnipresent provider of digital IP, network services, and critical back-end hardware.
Okay, before we pull apart the balance sheet, a quick required disclaimer for you guys. The limter pesany. Serious tur. Sarniro spilling. The limber box is checked on the Jantology. All right, legal box is checked. Let's get into the top-line figures for FY 2025.
Let's do it.
So Sony sales hit 12.48 trillion yen, which is, a 4% increase year over year. But top-line revenue isn't what caught my eye here.
No, it's the margin expansion.
Exactly. I mean, for anyone maybe not super familiar with the jargon, can we do a quick analogy like sales versus operating income versus net income? Let's use a bakery.
Oh, sure. So sales is basically all the money the bakery takes in from selling bread, just the raw cash in the register.
Right.
Operating income is what's left after you pay for, the flour, the baker's wages, keeping the ovens on the cost of actually running the core business.
And then net income.
That's what the owner actually takes home after paying the tax man, dealing with currency exchanges, and maybe paying interest on the bakery's bank loan.
Got it. Okay, so looking at the operating income, it landed at a staggering 1.447 trillion yen.
And that 13% year-over-year increase in operating income is the core story here. I mean, we really have to contextualize that figure against their own internal projections.
Right, because back in February, management actually forecast an operating income of 1.54 trillion yen.
Exactly. So at a surface glance, landing at 1.447 trillion looks like a miss, right? Like they fell short.
Yeah, but digging into the segment breakdown reveals something much more bullish.
Because if we strip out the impairment losses,
Mm-hmm.
those one-time hits they took in Q4, the base business was actually humming at an unprecedented level.
I was looking at the bridge chart from the earnings presentation, and the core profit engines, specifically gaming and the imaging and sensing segments, generated an additional 99 billion yen above that February baseline.
Yeah, so the underlying operational strength would have pushed the operating income to like 1.639 trillion yen if they hadn't decided to, clean house on some underperforming assets.
Which is insane. They are managing to extract significantly more operating profit out of what is a relatively mature revenue base.
Now, net income did see a slight contraction, down about 3.4% to 1.03 trillion in yen.
But that was largely due to tax structure fluctuations, right?
Yeah, and currency exchange headwinds. But institutional investors typically look past net income noise. They focus on the operating line because that dictates the ongoing viability of the core business.
Right. It points to this profound level of corporate resilience. I mean, I look at Sony right now like a heavily compartmentalized naval cargo ship plowing through a storm.
I like that analogy.
Like a massive macroeconomic wave hits the port side, maybe taking out their virtual production ambitions or stalling an electric vehicle rollout, and a smaller single product company, they capsize.
Oh, they ground immediately.
Exactly. But Sony has these distinct, structurally sound compartments. When one area floods, the gaming, music, and sensor compartments are generating so much free cash flow that they not only keep the ship afloat, they keep it moving forward.
And that structural resilience is totally deliberate. I mean, operating in consumer electronics and entertainment IP means you're constantly fighting rapid technological obsolescence, right?
Right, and shifting cultural tastes.
Exactly. You cannot build a durable empire on a single hardware lifecycle anymore.
Management's strategy has been to build interconnected pillars that hedge against each other's cyclical downturns. And if we analyze the FY25 operating income, the heavy lifting is incredibly concentrated. Over 50% of their total operating profit came from just two divisions.
Game and network services and music.
Let's pull apart the gaming segment first, because the unit economics of PlayStation have fundamentally shifted.
They really have. Historically, the narrative was entirely tethered to the console lifecycle.
Right, you design a box, sell it at a loss, or maybe break even to penetrate the market, and then you just pray to make it back on physical disc sales.
Yeah, but looking at the revenue mix now, the physical box under the TV feels increasingly incidental to the actual profit engine. The console is no longer the product.
Wait, so what does this all mean for you, the gamer? Are we seeing a shift where the box under the TV matters less than the subscription attached to it?
Absolutely. It is merely the point of sale for the ecosystem now. Sony refers to this internally as the platform business.
Okay, the platform business.
Right. The real margin expansion is coming from network services, primarily the tiered PlayStation Plus subscriptions and the digital sales of non-first-party games.
Which means every time a user buys, like, the latest third-party blockbuster digitally or pays for a battle pass in a free-to-play shooter, Sony takes a 30% toll.
Yeah, for doing nothing more than hosting the transaction.
Wow.
The marginal cost of delivering a digital copy of a third-party game or just maintaining a subscription tier is negligible compared to manufacturing, shipping, and storing a physical piece of hardware.
And when a user is locked into that digital ecosystem, their entire gaming library lives on Sony's servers. The friction required to leave and jump to an Xbox or a PC is immense.
That ecosystem lock-in is everything. It transforms gaming from a hit-driven, cyclical hardware business into a highly predictable, recurring revenue stream.
It's the ultimate evolution of the razor and blades model, and it insulates them from the traditional valleys of the console generation cycle.
Even if PlayStation 5 hardware sales begin to taper off as the console ages, the active user base is so massive and the ARPU, the average revenue per user, is so high that profitability remains totally insulated.
Right. They've also actively managed their R&D and marketing expenditures in the gaming division, haven't they?
They have, by focusing on extending the life cycle of the platform through live services and digital storefront optimization. They're maximizing the return on the initial capital they spent launching the PS5 back in 2020.
Okay, so the gaming platform proves the power of recurring digital revenue, but that still requires constant server upkeep and funding massive first-party studios.
Right.
What happens when you apply that same aggressive monetization strategy to an asset that requires zero new development?
Now you're talking about the music division.
Exactly, which just posted record-high profits.
The music segment's financial profile is just fascinating. The traditional music industry model was basically venture capital.
You sign 10 artists, assume 9 will completely fail, and hope the one breakout star covers all the losses.
Exactly. But Sony's strategy has evolved far beyond just A&R risk. It's no longer just about breaking the next pop sensation.
Right. The engine driving this profitability is the massive accumulation of legacy publishing and master recording catalogs.
When you look at the economics of global streaming, a classic rock anthem from 1985 or a massive pop hit from 1999 generates a perpetual, highly predictable stream of microtransactions.
Because every time that song is played on Spotify, Apple Music, or used in a TikTok video anywhere in the world, a fraction of a cent flows back to Sony.
Yep. It operates almost like a high-yield, zero-capex perpetual bond.
Zero capex, meaning zero capital expenditure. Once you purchase the rights to an iconic catalog, you don't have to fund studio time.
No studio time, no marketing tours, no manufacturing physical vinyl. The asset just sits there generating rent.
While global smartphone penetration continually expands the total addressable market of listeners.
And that is the crucial multiplier right there, the expansion of the global streaming market. As emerging markets adopt premium streaming subscriptions, the sheer volume of plays increases organically.
Sony Music is essentially monetizing the history of recorded audio on a global scale.
The margins on catalog streaming are astronomical, which is why it contributed so heavily to that 1.447 trillion yen operating income figure.
Okay, so we have the digital platform lock-in of gaming and the perpetual zero capex yield of music. But the third pillar of this fortress is purely physical.
The Imaging and Sensing Solutions Division, or INSS.
Right. Almost everyone listening right now likely has a Sony sensor in their smartphone. They posted 2.15 trillion yen in sales and 357.3 billion yen in operating income.
What's incredible to me is that they achieved this massive profitability in a global smartphone market that is, by all accounts, completely saturated.
Yeah, unit shipments for smartphones have been flat or declining for a while now, yet Sony's sensor division is printing money.
Well, this requires looking at the physics and the supply chain of modern smartphones. Sony is the undisputed dominant force in the manufacturing of CMOS image sensors.
Those are the semiconductor chips that convert photons into electrical signals, right? The digital eyes of the camera.
Exactly. While it's true that overall smartphone unit sales have plateaued, the composition of those phones has changed dramatically.
Oh, you're talking about the trend toward multi-camera arrays on premium devices.
Precisely. 5 years ago, a premium smartphone might have had one standard sensor on the back. Today, flagship models from Apple, Samsung, Chinese OEMs, they feature 3 or 4 distinct camera modules.
Wide, ultra-wide, telephoto.
Yeah, and each one requires its own massive, high-resolution CMOS sensor.
So even if a consumer is keeping their phone for 4 years instead of 2, when they finally do upgrade, they're inadvertently purchasing 3 times the amount of Sony silicon?
And it's not just the volume of sensors per device. It's the complexity and the pricing power. Sony has aggressively driven the transition to larger die sizes and stacked sensor architectures.
Wait, what exactly is a stacked sensor?
Good question. A stacked CMOS sensor literally separates the pixel layer that captures the light from the logic layer that processes the signal. It stacks them vertically to improve readout speeds and low-light performance.
Ah, I see. And these advanced sensors obviously command a significant price premium.
Exactly. And the earnings call explicitly cited improved yields as a driver of this profitability.
For the listeners deep in the tech space, semiconductor manufacturing is basically a brutal game of defect management, right?
Totally. If Sony is improving their yields, it means they are successfully printing these highly complex, stacked sensors with fewer errors per silicon wafer.
Which dramatically lowers their unit costs.
Right. They are reaping the harvest of a massive capital expenditure cycle. During their previous mid-range plan, management poured nearly 1 trillion yen into expanding their fabs and refining these nodes.
The R&D phase was highly capital intensive, but now those fabs are fully operational, the yields are optimized, and the leverage is flowing directly to the bottom line. Okay, so the 3 core engines, gaming, music, sensors, are operating at peak efficiency. But we cannot analyze this earnings report accurately without doing a deep autopsy on the bleeding edge of the balance sheet.
Oh yeah, the risk assets.
Right. To really understand the pragmatism of Sony's management, we have to look at the staggering write-offs they executed in Q4.
The impairment losses. This is where we see the cold, calculated side of corporate governance.
Let's explain that term for a second. An impairment loss, simply put, is like realizing something you bought is no longer worth what you paid for it and officially adjusting the receipt.
That's a great way to put it. It occurs when management acknowledges that the carrying value of an asset on a balance sheet exceeds its recoverable amount. It's a formal admission that past investments aren't going to generate the future cash flows they originally modeled.
The loudest example in the Q4 report was the 88.6 billion yen impairment charge against Bungie.
Yeah, that was huge.
I mean, Sony acquired the legendary studio behind Destiny and the original Halo for roughly $3.6 billion back in 2022. Taking a nearly 90 billion yen write-down against the intangible assets of that acquisition just 2 years later, that is a massive recalibration.
It really is.
Why did they buy Bungie in the first place, and why did the model break so quickly?
Well, the Bungie acquisition was the cornerstone of Sony's aggressive pivot toward games as a service or live service games.
Because historically, Sony excelled at single-player, narrative-driven prestige titles.
Right, like The Last of Us or God of War. But single-player games, while culturally impactful, do not generate the recurring daily revenue streams that a live service multiplayer game does.
So Bungie, with its decade of experience running Destiny 2, was supposed to provide the internal infrastructure and expertise to help Sony launch, like, a dozen live service titles.
Exactly. But the macroeconomic environment for gaming shifted violently post-pandemic. The live service market became totally oversaturated.
Players only have a finite amount of time. trying to break into a market dominated by entrenched behemoths like Fortnite or Apex Legends proved to be incredibly hostile.
We saw massive layoffs across the industry, project cancellations, and a clear consumer fatigue with the Battle Pass monetization model.
And that industry-wide contraction directly impacted Bungie's projected future cash flows.
Right. When consumer engagement metrics in Destiny 2 softened and the pipeline for new live service titles was rationalized, Sony's accountants had to look at the goodwill and intangible asset value recorded from the acquisition and mathematically adjust it downward.
It's a painful accounting reality. But writing down 88.6 billion yen on the balance sheet doesn't actually cost them cash today, right?
Correct. It's a non-cash charge that right-sizes the books.
They also took a 27.1 billion yen hit against Pixamondo, their virtual production and VFX subsidiary.
Yeah, virtual production using massive high-resolution LED walls instead of green screens was heralded as the future of filmmaking during the pandemic.
But as the entertainment industry faced strikes and a massive contraction in content spending, the utilization rates for those expensive LED volumes just plummeted.
And the Pixamondo impairment is particularly instructive because it included related shutdown costs. It demonstrates that management isn't just tweaking a spreadsheet, they are actively closing underperforming physical facilities.
They're looking at the ROI of every subsidiary, and if the timeline to profitability is too long, they're aggressively cutting the cord.
Which brings us to the most visceral example of cutting the cord.
The Sony-Honda Mobility joint venture.
Right. They announced they are officially discontinuing the launch of their highly anticipated electric vehicle, the Afeela, and significantly downsizing the entire business operations.
The automotive pivot was always their most ambitious and arguably riskiest venture.
The logic was sound on paper. Modern vehicles are essentially rolling computers. If Sony could provide the infotainment, the sensors, and the network connectivity.
And Honda could bend the metal and manage the physical supply chain.
Exactly, they could disrupt the EV space.
But let's look at the actual accounting mechanics of how this failure hit the books. Because it's a joint venture, Sony doesn't consolidate all the R&D costs and factory leases line by line. They use the equity method of accounting.
Yes, the equity method is vital to understand here. Because Sony holds a significant but shared stake in the venture, they record the initial investment on their balance sheet.
Okay.
Then, at the end of each quarter, they take their proportionate share of the joint venture's net loss or profit and record it as a single line item on their own income statement.
So if the Sony-Honda Mobility entity burns through 100 billion yen trying to design a chassis, and Sony is on the hook for half, Sony simply records a 50 billion yen loss under their all-other category.
Exactly. And in Q4, Sony recorded an additional 44.9 billion yen loss through the equity method directly related to this EV venture.
And they are modeling another 30 billion yen in anticipated losses for FY26 as they wind down operations.
That is over 70 billion yen in combined losses for a car that will never hit a consumer driveway.
Which, to the casual observer, spending billions of yen to build a prototype and then abruptly throwing it in the trash looks like a catastrophic strategic failure.
It does look bad.
But when I look at the broader macro conditions of the EV market right now, the brutal price wars initiated by Chinese manufacturers, the cooling consumer demand due to interest rates, the massive capital required to scale manufacturing, I actually view killing this car as an act of extreme operational discipline.
It is the absolute antithesis of the sunk cost fallacy. There is a deeply ingrained corporate psychology that insists on launching a product simply because billions have already been spent developing it.
Right, but launching a physical automobile requires a staggering amount of working capital for inventory, marketing, distribution networks.
By pulling the plug before they had to scale mass production, management protected their future cash flows from a low-margin, highly cyclical bloodbath.
They took the PR hit today to protect the balance sheet tomorrow.
Completely.
And it frees up all that capital and engineering talent to focus on areas where they actually have a monopolistic advantage, which transitions us perfectly into what I consider the most critical strategic move in this entire earnings cycle.
The TSMC partnership.
Yes. While they were busy burying an electric car, they were simultaneously signing a memorandum of understanding with TSMC that could fundamentally alter the semiconductor supply chain.
The non-binding MOU between Sony Semiconductor Solutions and TSMC, Taiwan Semiconductor Manufacturing Company, to explore a joint venture in Kumamoto is just a tectonic shift.
The plan outlines Sony acting as the majority shareholder in a new fabrication plant dedicated to developing and manufacturing next-generation image sensors. Here's where it gets really interesting. Why TSMC and why now?
Well, let's break down the technical synergy here. We discussed earlier how a stacked CMOS sensor has two distinct layers: the pixel layer that captures the light and the logic layer that processes the digital signal.
Right. And Sony has unparalleled IP and design mastery over the pixel layer. Nobody in the world builds a better photon trap than Sony.
Exactly. However, the logic layer, the silicon that handles the computation, the autofocus algorithms, the signal processing, relies on advanced semiconductor manufacturing nodes. And TSMC is the undisputed global leader in advanced node fabrication.
So instead of Sony trying to spend tens of billions of dollars to compete with TSMC on advanced logic manufacturing, they are bifurcating the process.
They're partnering up, bringing their pixel IP to the table, and utilizing TSMC's mastery of logic node manufacturing.
It's a flawless strategic alignment. Sony secures guaranteed access to world-class manufacturing scale for the most complex parts of their sensors, insulating them from global fab shortages.
And TSMC, in turn, deepens its geopolitical and manufacturing footprint in Japan, supported by an anchor client.
The press release carefully noted that this entire venture is contingent on Japanese government support, right?
Yes, which aligns with the broader global movement of nations heavily subsidizing domestic semiconductor supply chains to reduce reliance on vulnerable global shipping routes.
But the truly fascinating part isn't just how they are building these chips, it's what they are building them for. The press release used a buzzword that we really need to unpack: physical AI.
Right.
We've spent the last 2 years obsessed with generative AI, large language models, chatbots, image generators, but that entire ecosystem lives in the cloud. It's digital. What exactly is physical AI?
Physical AI represents the transition of artificial intelligence from the digital realm into the tangible physical world. It is the integration of advanced neural networks into physical machines, allowing them to perceive, interact with, and navigate their environment in real time.
But a neural network, no matter how advanced, is completely blind without sensory input.
It needs eyes.
Exactly.
Think about the architecture of an autonomous vehicle. The onboard computer is processing immense amounts of AI data, but that processing is entirely dependent on the high-fidelity, low-latency data streams coming from LiDAR, radar, and crucially, ultra-high-resolution CMOS image sensors.
The AI needs to instantly distinguish between a pedestrian and a shadow, in the rain, at night, at 60 miles per hour.
That requires sensor hardware capable of capturing vast amounts of data and performing initial signal processing on the edge before the data even hits the main computer.
And that is exactly what the Sony-TSMC joint venture is designed to produce. They aren't just building sensors for smartphones anymore. They're building the critical sensory infrastructure for the entire robotics and autonomous vehicle industries.
Factory automation robots that need to visually inspect micro-welds, delivery drones navigating complex urban topography. They all require advanced physical AI sensors.
This completely reframes the narrative around killing the Sony Honda Mobility project. It is a masterful pivot up the value chain.
It really is.
Building a finished electric vehicle is a brutal, low-margin business fraught with consumer liability and massive supply chain complexities. By abandoning the car and focusing entirely on the TSMC joint venture, Sony's strategy becomes so clear.
We refuse to compete in the low-margin knife fight of building the actual car. Instead, we're going to establish a monopoly on the high-margin, indispensable sensor technology that every single automotive manufacturer in the world will have to buy from us.
It is the ultimate picks and shovels play during a gold rush. They abandon the high-risk consumer product to become the indispensable component supplier.
And that transition from high-risk hardware to high-margin software and components directly impacts their financial modeling for the future.
Right. The FY 2026 consolidated forecast. It contains this fascinating contradiction that highlights their whole corporate philosophy. Sony expects total sales to actually decrease by 1%, dropping down to 12.3 trillion yen.
But in the same breath, they project operating income to increase by 11%, reaching 1.6 trillion yen.
Selling less product but generating significantly more profit. How is that possible?
This is a deliberate margin mix shift. They're actively shedding low-margin revenue streams and aggressively expanding their high-margin digital and component divisions.
We can see this vividly in the FY 26 gaming projections. They forecast a drop in gaming sales of over 265 billion yen, which Wall Street assumes is the natural tapering of physical PlayStation 5 sales.
Yet, despite forecasting a $250 billion drop in top-line gaming revenue, they expect the operating income for the gaming segment to actually surge by 136.7 billion yen.
Because the network services, the digital storefront cuts, the PlayStation Plus subscriptions, they have incredibly low marginal costs. Once the server infrastructure is scaled, almost every incremental dollar of subscription revenue flows directly to the bottom line.
And this structural margin expansion is why the analyst community is so bullish. Reading through the reports from BofA Global Research and CFRA, Sony is executing its mid-range plan with ruthless efficiency.
The initial target was to achieve an operating income compound annual growth rate of greater than 10%.
And from FY23 to FY24, they blew past that, achieving a 23% growth rate.
When a company generates that level of free cash flow, the immediate question from investors becomes, what are you going to do with all that cash?
Well, you aren't building a car factory anymore, and you aren't doing massive acquisitions after the Bungie impairment.
The BofA report highlights the payout ratio as the key metric to watch here.
The payout ratio is a critical indicator of management's confidence. It represents the percentage of net income that is distributed to shareholders in the form of cash dividends and share repurchases.
In FY24, Sony's total payout ratio was sitting at roughly 31%, a respectable figure for a tech giant.
But the trajectory is steep. Driven by the massive free cash flow from their capital-light divisions, BofA estimates that Sony will drive that total payout ratio up to a staggering 57% by FY26.
So they are actively buying back their own stock, reducing the total float and increasing the earnings per share for remaining investors while simultaneously hiking the dividend.
It is a massive transfer of wealth back to the owners, signaling absolute confidence that their R&D and capital expenditure cycles have peaked and they are now in the harvesting phase.
But the cash returns are only part of the shareholder value equation. Let's talk about the elephant in the room. The upcoming partial spin-off of the financial services business scheduled for October 2025.
Yes, the financial arm.
Sony has historically operated a massive, highly profitable life insurance and financial services arm in Japan. It seems counterintuitive to chop off a profitable limb. Why force the spin-off?
It comes down to capital efficiency and valuation multiples. Operating a life insurance company requires adhering to incredibly strict regulatory capital requirements. You must hold massive amounts of cash and low-yield bonds in reserve to guarantee future payouts.
That traps capital on the balance sheet. It makes the overall corporate structure incredibly capital-heavy.
And Wall Street hates capital-heavy conglomerates because they drag down the return on equity metrics.
Exactly. Sony's strategic goal is to be valued by the market as an agile, high-margin, capital-light IP and technology company, like a software or pure-play entertainment firm,
which command significantly higher price-to-earnings multiples. The financial wing, despite its profitability, acts as an anchor on that valuation.
So by spinning off the Sony Financial Group into an independent, separately listed entity, Sony instantly sheds those massive regulatory capital reserves from its consolidated balance sheet.
But the mechanics of how they are executing this spin-off are brilliant. They aren't just selling the insurance business to a private equity firm and keeping the cash.
Right. The filings detail the use of a dividend in kind. Walk me through how this physically works for someone holding Sony stock today.
A traditional dividend distributes cash from the company's treasury directly into your brokerage account. A dividend in kind, however, distributes physical assets. In this scenario, Sony is using its ownership shares of the newly formed Sony Financial Group as the currency for the dividend.
So on the execution date in late 2025, if you own shares of Sony Group, you will wake up and find that your brokerage account has automatically been credited with shares of the new independent Sony Financial Group at no additional cost to you.
Precisely. It is a highly tax-efficient way to unlock shareholder value. Sony Group achieves its goal of becoming a pure-play, capital-light entertainment and technology giant.
And the existing shareholders don't lose the underlying value of the insurance business. They simply hold it as a separate, distinct asset.
Exactly.
It's a masterful piece of financial engineering. But, as we look across this landscape, the soaring margins, the AI joint ventures, the spin-offs we have to temper the optimism by looking at the dense, heavily lawyered risk factors section of the financial reports.
The macro environment is incredibly volatile right now.
Yeah, it's like they're building this high-tech fortress, but realizing their supply lines for the actual bricks are highly vulnerable to the weather. What should the listener be watching out for?
The risk factors outlined by management generally synthesize into 3 systemic threats. The first is the sheer velocity of technological obsolescence and relentless price competition.
especially in smartphones and TVs. Even though they are shifting to software and components, they still rely heavily on the continuous upgrade cycles of premium devices to drive volume.
Yes, and the consumer electronics market is ruthless. If global consumer spending contracts, the upgrade cycle for a smartphone elongates from 3 years to 5 years.
That directly impacts the volume of image sensors Sony can ship, regardless of how advanced their TSMC joint venture is.
Furthermore, competitors are aggressively attempting to commoditize sensor technology, exerting constant downward pressure on pricing.
Which means if Sony fails to continuously innovate, their premium pricing power just evaporates.
The second major risk factor is their reliance on external business partners.
Right. Sony's transition to a platform and component model means they do not operate in a vacuum. They rely on third-party fabs, external logistics networks, and third-party software developers.
If there is a localized disruption in global shipping lanes, or a severe geopolitical export restriction on critical materials, this entire finely tuned hardware ecosystem can grind to a halt.
They are only as resilient as the weakest node in their external supply chain.
And the third major macroeconomic threat revolves around global economic volatility, specifically regarding interest rate fluctuations and foreign exchange rates.
As a global exporter, the strength of the yen against the dollar directly impacts their reported revenues.
But more acutely, until the financial spinoff occurs in late 2025, they are highly exposed to bond market volatility.
Oh, because the life insurance arm holds massive portfolios of government bonds. If global central banks unexpectedly pivot their interest rate policies, the valuation of those massive bond portfolios can swing wildly.
Impacting the consolidated net income of the entire group. They are navigating a transition period fraught with macroeconomic landmines.
It requires flawless execution from the executive team. I mean, we've covered a massive amount of technical and financial ground today. Could you pull it all together for the listener, just a clear summary of Sony's current position based on our analysis?
Certainly. Stripping away the noise, here are the 4 foundational takeaways from Sony's earnings and strategic outlook. 1. They achieved record profits, 1.447 trillion yen, driven by gaming, music, and sensors.
Right.
2. They are aggressively cutting dead weight, downsizing the EV project and writing off underperforming game and VFX assets. 3. They are securing their future hardware dominance through the TSMC partnership for physical AI.
And 4.
And 4, they are transitioning to a capital-light model by spinning off their financial wing in late 2025.
It really is a masterclass in corporate evolution playing out in real time. Thank you for dissecting the mechanics behind the numbers. It completely changes how we view their market position.
Oh, it's been my pleasure. It's a fascinating case study.
And to you, our listener, I want to leave you with a final thought to ponder. If you look at the trajectory we mapped out today, look at the sheer scale of the digital and component infrastructure they are building. Sony is completing a decades-long transformation. They are no longer just the company that manufactured the physical Walkman in your pocket or the TV in your living room. Today, they own the streaming rights to your favorite songs, the network you game on, and they are aggressively positioning themselves to manufacture the physical AI eyes of the robots of the future. Are we witnessing the ultimate evolution of a hardware giant into an invisible yet omnipresent software and services empire? Something to think about the next time you tap your phone screen. See you next time.